So get this. Coeur d'Alene's overall multifamily vacancy rate actually hit 10.0% in Q3 2025. But here's the twist. The market absorbed 703 units over the last year. Tenant demand seems surprisingly resilient. Welcome into the deep dive. We dig into the source material to pull out the essential insights for you. Today, we're cutting through the numbers in the Q3 2025 market report for the Coeur d'Alene, Idaho multifamily sector. Now, this deep dive, it's based completely on the figures and the analysis right in that report. Our goal is to, really distill what's shaping this unique Pacific Northwest market, and we'll do it in under 15 minutes.
Absolutely. And just a quick note, if you need deeper context, maybe a custom breakdown after this, the direct contact for the report is Eric.Peterson. We'll give you his number again at the end.
Okay, great. So let's unpack the quarter. If you only remember one thing about Q3, what should it be?
I'd say it's this. The Coeur d'Alene market is simultaneously starved for capital and dealing with pretty high vacancy. It creates this kind of structural paradox. You've got strong demand bumping right up against zero future supply.
A paradox. Okay, let's break that down. What are the core headlines for Q3 then?
Right. 4 things really stand out. First, demand stability. Let you mention, net absorption was 703 units over the last 12 months. That significantly outpaced net deliveries, which were only 449 units. And the key thing, this actually led to a year-over-year vacancy rate decrease of 3.2%.
Wow. Okay, so yeah, the market's actively chewing through the available space that's already there.
Exactly. Which brings us to number 2, and honestly, this might be the biggest headline, supply freeze. The construction pipeline, it's basically non-existent. The report is very clear. 0 properties currently listed as under construction.
Just 0. That's
Correct.
quite a number compared to recent years.
It's a dramatic drop. I mean, the market's 10-year average pipeline is around 770 units. So 0 is, yes, significant.
Okay, 0 supply coming.
Yes, well,
Money side, investment.
Headline 3, capital inertia. Sales volume tracked at, get this, $0 for the year to date in 2025.
$0. So no reported sales volume at all?
Correct. It reflects a total transaction freeze, and this is despite the estimated market cap rate sitting at 6.7%, which, is a full 70 basis points higher than the national average of 6.0%. So higher potential returns, but no deals happening.
Interesting. Okay, demand, supply, capital. What's the last headline?
Finally, the rent plateau. Average asking rent growth over the past year was pretty modest, just 0.9%. It really shows that even with that strong absorption, the high current vacancy rate, that 10.0%, it's still limiting how much owners can push rents.
Okay, this is where it gets tricky for me. We've got solid population growth, right? 1.7% annually, people moving in, and we're absorbing 700 units year over year. But rents are basically flat at 0.9% growth. How does that work? Is it just that the 10% vacancy number is still weighing things down, or are we hitting some kind of affordability wall?
It's probably, a bit of both, but the data really suggests it's mainly a lag effect. And it depends on which part of the market has that high vacancy. See, the overall vacancy is 10.0%, sure. But if you drill down by asset class, the picture changes quite a bit. That underlying stability, the absorption, it's definitely fueled by that strong domestic migration, especially from other Western states. People are moving here for the lifestyle and, well, what they see is better affordability. That keeps the demand engine running.
And those people are filling up the cheaper units first, I assume.
Exactly. You nailed it. The older, typically more affordable 1- and 2-star properties, they're practically full. We're talking just 4.9% vacancy there, super tight.
Wow.
But then you look at the 3-star assets, they're struggling more at 11.3% vacancy. And the newer 4- and 5-star properties, also higher, 10.4% vacancy. So yeah, current demand is very cost conscious. It's focused heavily on that entry-level stock. The high vacancy is really concentrated in the mid to high end, and that's what's putting the brakes on overall rent growth.
Got it. So if the older affordable stuff is getting snapped up, that supply freeze you mentioned becomes even more critical. 0 properties under construction.
Yeah.
That sounds like a recipe for, well, significant problems down the line, maybe 18, 24 months out.
That is absolutely the defining signal from this Q3 report. That 0 construction figure isn't just low, it's a critical data point. Especially when you consider the current inventory, about 9,700 units is mostly older stock. The typical complex is maybe 60 units built back in the 70s or 80s.
And how does that 0 pipeline compare to what was actually delivered recently?
Well, deliveries this year are way down, only 173 market rate units year to date. Compare that to 2023 when we saw 1,366 units delivered. So yeah, the construction sector basically slammed on the brakes.
Why? High financing costs, maybe? Or concerns about that higher end vacancy?
Likely both. High financing costs are definitely a factor nationwide, and maybe some worry about oversupplying the high end after the recent boom.
So zero new inventory meets that strong 1.7% population growth. You're right, the lack of new supply is going to fundamentally shift things between landlords and tenants come 2026. What did the report suggest this means for owners of that older 1970s era stock?
Well, for current tenants, maybe there's a brief period where rents aren't skyrocketing overall, but for owners of that aging inventory, the complete lack of a construction pipeline definitely points towards future rent upside potential. But here's the catch with transactions frozen because of that capital inertia. It's tough for those owners to sell or get financing to, renovate that stock. They're kind of stuck between potential future rent growth and the current high cap rate demands from buyers and lenders.
Right. And since owners aren't seeing huge overall rent growth now, are they likely to drop prices to meet those investor demands for, what was it, a 6.7% cap rate? Let's pivot right into that capital markets picture.
Yeah, the market is clearly frozen is the right word. That $0 sales volume YTD really says it all. Buyers are demanding much higher yields. That estimated cap rate, 6.7%. It's key because it's 70 basis points higher than the national average of 6.0%.
So what does that extra 0.7% spread really signal to an investor looking at Coeur d'Alene?
It's essentially a liquidity premium. Or maybe a risk premium. Investors want that higher return to offset the perceived risk and, frankly, the difficulty of selling quickly in this market if they needed to, and the zero sales volume. It just shows that sellers aren't willing or maybe able to meet that pricing yet. It's a standoff.
A standoff.
Yeah.
Yet you mentioned 2 deals did close in Q3. If the market's frozen, what do those specific sales tell us? Where is the liquidity?
Good point. The deals that did close really confirm what we talked about with segmentation. Properties with strong tenant health, especially in that affordable segment, they still have liquidity. The first one was Peaks at Falls Park, 74-unit, 2-star property, closed late July. And critically, its vacancy was only 4.1% when it sold. That really underscores the demand for affordable housing.
Okay, so lower end, stable property traded. What was the other one?
The second was 1810 North Spokane Street. Smaller, 22 units, but a 4-star property. Closed early September. And it showed similarly strength vacancy was super low at 4.6%. So these deals show that, quality, well-leased assets, kind of regardless of star rating, they are moving. But only at prices that work for both sides, which seems rare right now, leaving most of the market static.
That's really crucial context. Okay, so for investors who are willing to jump in, what's the general pricing level look like?
Well, the estimated market pricing kind of averaged across all classes in Coeur d'Alene is around $130,000 per unit, which, is substantially lower than the national average of about $230,000 per unit.
So cheaper on a per unit basis than many places, but you need to accept that higher required return, that higher cap rate.
Exactly. The absolute cost might look attractive, but you have to be comfortable with the current yield demands and maybe lower liquidity.
Okay, let's look ahead then. We've got this complex mix, flat rents, high absorption, zero construction. What's the report's outlook for Q4 and into 2026?
The forecast suggests vacancy will continue to ease. The prediction is it'll actually drop below 9% by the end of this year, 2025.
Below 9%. That feels like a significant threshold.
It is. Psychologically and economically for the area, getting back into single digits would be a big deal. And as vacancy tightens, they're forecasting annual effective rent growth to finish 2025 around 1.4%. That's assuming, no major economic curveballs.
Right. And what are the main risks or things investors should keep an eye on?
Well, the primary risk mentioned is the market's exposure to tourism and recreation jobs. If there's a prolonged economic downturn impacting those sectors, it could definitely slow down leasing and stop that modest rent growth. But honestly, the single most critical thing to watch is that long-term structural supply gap, that zero construction number. If the strong in-migration continues that 1.7% growth, the total lack of new units in the pipeline is going to dramatically shift pricing power towards landlords, probably in the next 18 to 24 months.
So wrapping this up, what does it all mean for you listening? Q3 in Coeur d'Alene was really defined by this tension. Resilient tenant demand, running into very cautious capital. The affordable housing segment is humming along, filling up fast. The high end is struggling a bit with vacancy. And the big story for 2026 looks like it'll be the impact of that zero-unit construction pipeline hitting continued population growth. The market's basically waiting for that capital freeze to thaw.
That's a great summary. And as we mentioned, for a deeper dive into any specific submarkets or different asset classes, or if you want a custom market breakdown based on this Q3 2025 report, please feel free to contact Eric Peterson. His number is 509-903-9077.
Thank you for joining us for this deep dive into the Q3 2025 Coeur d'Alene multifamily market.